So we're going to look at the effect of gamma on the long call strategy. So let's talk about what gamma is first of all. Gamma is the rate of change of delta for every $1 move in the underlying share price. So that's really important. If you're buying call options and you start doing your calculations as to what you think your call option is going to be worth, let's say if the share price rises $5 and you're using the existing delta amount, that's not exactly the right way to do it, because as the share price moves, so does the value of the delta. So what gamma does, it helps you to identify a target price for your option if the share price moved up to your new target price. So that's what gamma does. But the one thing before we move on and do an exact example of delta and gamma, we want to show you the difference in the gamma values for May the 27th and January 2017. So you will see here under gamma, you will see for the exact same strike prices that the gamma of the shorter term options is a lot higher than the gamma of the longer term options. And the key takeaway for you from this is that that means that the option price will be more volatile with the shorter term options than the longer term options. So that's one key takeaway from gamma as well. Let's look at an example with delta. So let's take the January 2017 calls and the 208 strike. So we're looking down here. You can see that the delta is 0.5115 and the gamma is 0.0149. What would happen if the share price moved up or down by $4, for example? So we've prepared a presentation on the next slide here for you. So here's day one. The share price when we bought our call option was 207.78. The option price was 1041 stroke 1025, so that was the ask price was 1041. That's what we paid to buy it, but we also noted the bid price was 1025. Our delta was 0.5115, our gamma was 0.0149, and of course we've only bought it, so there's no profit or loss. So let's say we get to day two and the share price has dropped $1. Well, you'll notice there that the bid and the ask here will drop by the delta amount here. So the delta amount from day one. So that means that your new bid and ask will be 990 stroke 974. Your delta though will also change here by the gamma amount. So you can see here that our new delta will be the previous delta minus the gamma rate for the previous day. So you can see 0.5115 minus 0.0149 will give us 0.4966. So that will be our new delta from there on. And we're in an overall loss situation of $67 per contract because we bought the call option at 1041, and now if we were to sell it we would only get 974. So that's a loss of $67 per contract. Going into day three, let's say there was another $1 drop in the share price. That would mean there that the new bid and ask would go from 990 stroke 974 down to 940 stroke 924. And that again is just the previous day's prices minus the delta amount for the previous day. Our delta though will have also changed again. Our delta will now become 0.4817. That's equal to your 0.4966 of the previous day's delta minus the gamma amount because we dropped the share price. And our overall profit and loss will be $117 per contract. And we continue to do this and so on and so forth. So you can see here that our delta amount is constantly changing as the share price kept dropping on us by the gamma amount. And then our loss changes with that as well. But what happens if the share price rises? Well, again, if we look at day one, our share price was 207.78. Our bid and ask for the option was 1041, 1025, our delta and our gamma, and of course we'd no profit because we've just bought the option. But now the share price jumps to 208.78. This time our delta has moved up to 0.5264 because it's the previous day's delta plus the gamma amount. And now you will see our option price has moved up from 1041 to 1092 and from 1025 to 1076 because it's the previous day's option price plus the delta amount. And we're in a profit in this day of $35 per share. If we get to day three and the share price moved up another dollar, our option price would go up by the previous day's options bid and ask plus the delta amount, and that equals 1144 stroke 1129. Our delta would also change by the previous day delta amount plus the gamma amount, so your new delta becomes 0.5413. And then our profit and loss will be $88 per share. So you can see by the time we get to day 5, if the value of the shares kept rising by $1, our option price quotes will get to roughly 1254 stroke 1239, and we'll be in a profit of a loss of about 198 per share. So that's why it's important to know about delta and gamma. Delta, as the share price moves, also moves, and that's really important to know that when you're trying to estimate what the value of your calls are going to be if you have a specific target price in mind.